Good day, everyone. We find ourselves in a rather interesting time. U.S. pending home sales, a key indicator of the health of the housing market, are currently at a 22-year low. Today, we're going to delve into the current state of U.S. pending home sales. It's an intriguing scenario we're looking at. Despite a dip in mortgage rates, contract signings for existing homes have remained stagnant. It's like a car stuck in neutral, going neither forward nor backward. This stagnation has kept the index for pending home sales at a low of 71.6, the lowest since the index's inception in 2001. Now you might think lower mortgage rates would entice more buyers to sign on the dotted line, but that doesn't seem to be the case. There's a hesitancy in the market, like deer caught in headlights. Buyers may be waiting out seasonal trends or perhaps holding off until after the holiday season. It's hard to pinpoint exactly why, but the fact remains, the market is at a standstill. And it's not just the pending home sales that are feeling the pinch. The overall activity in the resale market has also taken a hit, down by 5.2% compared to the previous year. That's like a boxer taking a left hook to the jaw, but still standing, if a bit unsteady. But it's not all doom and gloom. The dip in mortgage rates has brought a silver lining, improving homebuyer affordability. The average monthly cost for conventional loans saw a decrease in November. It's like a small ray of sunshine peeking through a cloudy sky. However, the question remains, why are buyers still holding back despite the dip in mortgage rates and improved affordability? It seems there are other factors at play here, keeping buyers at bay. To understand the situation, we need to take a look at mortgage rates. They've been on a roller coaster ride recently. Mortgage rates, much like a southern porch swing, have been gently swaying, reaching their lowest point since the heat of last June. The rate on the traditional 30-year fixed mortgage has dipped to 6.67%, down from 6.95% just a week prior. This, after rates had reached a peak of 7.79% in the crisp days of October. This decline in mortgage rates didn't just happen on a whim. It's like a well-planned family barbecue. The Federal Reserve's decision to keep its benchmark rate steady, coupled with whispers of possible rate cuts come 2024, have contributed to this decline. It's as if the Fed has been fanning the flames, gently lowering the heat under the pot of the housing market. But here's the catch. Even though the mortgage rates have been as inviting as a cool glass of sweet tea on a hot day, home buyers are still hesitant to enter the market. It seems the affordability challenges are proving to be a tougher nut to crack than a Georgia pecan. Despite the lower rates, the dream of homeownership remains just that for many, a dream. The volume of applications to purchase a home has decreased by 1% compared to the same period last year. It's like the housing market is throwing a party, but the guests are reluctant to show up. Affordability has shown modest improvement, like a shy debutante making her first appearance at the ball. But it appears it's still not enough to coax buyers back into the market. The lack of inventory remains a major roadblock on the path to homeownership, as home prices continue to climb higher than a Georgia pine. Lower mortgage rates haven't seemed to lure buyers back into the market as expected. It's like a well-stocked fishing pond where the fish just aren't biting. So we find ourselves in a bit of a conundrum, with low rates on one hand and hesitant buyers on the other. It's a delicate dance, y'all, and only time will tell who will take the lead. Affordability and inventory levels are two major factors influencing buyer decisions. Let's take a closer look at how these elements are playing out in the current housing market. In recent times, homebuyer affordability has seen a slight uptick, thanks to a decrease in mortgage rates. This dip has led to a reduction in the average monthly cost for conventional loans. On the surface, this is good news, right? But hold your horses, because it's not all sunshine and roses. While improved affordability should theoretically draw more buyers into the market, we're not seeing that in reality. Despite the lowering of mortgage rates, potential home buyers remain hesitant. One might wonder, why is this happening? The answer lies in the other side of the coin: inventory levels. Inventory, or the number of homes available for sale, is a significant factor affecting affordability. When inventory levels are high, buyers have more options, and this can help keep prices in check. But that's not the case we're dealing with right now. Instead, we're seeing inventory levels that are significantly below typical norms. This scarcity of homes for sale is driving home prices upward, offsetting the benefits of lower mortgage rates. And these rising prices are posing a major obstacle to affordability, making it harder for buyers to make their dream of homeownership a reality. So, what we have here is a somewhat paradoxical situation. Even as mortgage rates dip, boosting affordability, the shortage of inventory is pushing home prices up, making homes less affordable overall. This tug-of-war between affordability and inventory levels is creating a tough market for buyers. In essence, while the dip in mortgage rates has led to improved homebuyer affordability on one hand, the lack of inventory is a major obstacle on the other. The continual rise in home prices driven by this scarcity of available homes is keeping potential buyers on the sidelines. With inventory levels significantly below typical levels, buyers are facing a tough market. It's a dynamic situation, and as always, those looking to buy a home must stay informed and be ready to navigate these challenging waters. Looking ahead, economists expect some changes in the housing market. In the coming years, particularly by 2024, the mortgage rates are projected to cross the 6.5% mark. This increase might seem like a potential hurdle for homebuyers, considering the current affordability challenges. However, it's anticipated to fuel an upswing in transactions. Now, you might wonder, how would higher mortgage rates lead to more transactions? Well, higher rates often incentivize homeowners to sell, hoping to capitalize on the increased borrowing cost. This could result in an influx of properties on the market, offering more choice for potential buyers. But there's a twist to this tale. While more transactions could mean more options for home buyers, it could also drive up house prices. This is where the balancing act comes into play. Higher mortgage rates could lead to increased supply, but they could also propel prices upwards. It's a delicate equilibrium, and its impact on the housing market will be fascinating to watch. Speaking of supply, there's been a recent spark of activity from home sellers. This past November saw an uptick in newly listed homes, adding a much-needed boost to the overall inventory. While it's a positive sign, it's important to note that inventory levels are still significantly lower than typical. This shortage has been a key player in the current state of the housing market, and its evolution will significantly influence the market's future. So as we gaze into the crystal ball of the housing market's future, it's clear that a few key factors will steer its course. Mortgage rates, inventory levels, and buyer affordability will dance a complex waltz. How they move and interact will shape the contours of the housing market in the coming years. The future of the housing market seems to be a balancing act between mortgage rates, inventory levels, and buyer affordability. As we navigate these interesting times, staying informed and proactive is key. The housing market can often feel like a roller coaster ride with its highs, lows, and unexpected turns. Yet, even in the face of a 22-year low in pending home sales and the challenges of low inventory, there are opportunities to be found. Consider the current situation. Yes, mortgage rates have dipped, reaching their lowest level since June. But it's important to see the bigger picture. The dip in rates hasn't spurred the expected surge in home buyers. Many are still hesitant, faced with affordability challenges and a lack of available homes. Yet there's another side to the coin. The decrease in the average monthly cost for conventional loans has improved homebuyer affordability. And while inventory levels remain significantly below typical levels, home sellers have become more active, with an increase in newly listed homes. So if you're thinking about buying a home, it's crucial to keep an eye on these trends. Remember, the housing market isn't just about numbers and rates. It's about people and their dreams of owning a home. It's about finding a place where you can build a life, make memories, and find a sense of community. So yes, the challenges are real, but so are the opportunities. Thank you for joining us today at New Way Finance Academy. Don't forget to hit like, subscribe, and turn on notifications to stay updated. Until next time.